After several days of in-depth analysis of the global markets, I'm ready to walk you through the 10 key reasons gold continues to rise in 2026. Let's begin with this. For 5,000 years, gold has outlived every currency that once dominated its time. Today, as global debt approaches critical levels and the dollar faces increasing structural risks, history appears to be repeating itself. If you fail to pay attention to these 10 specific factors, you may miss the largest wealth transfer of our lifetime. To begin, let's understand the reason behind the aggressive gold accumulation by central banks. For decades, central banks relied on U.S. Treasury bonds as the core of their reserves, trusting the dollar system as the backbone of global finance. That trust was built on stability, liquidity, and the assumption that American debt would always remain the safest asset in the world. But in recent years, a quiet shift has begun. Central banks are buying physical gold at historically high levels, not paper exposure, not financial instruments, but actual bars stored in vaults. It is long-term protection. When regulators move reserves from dollar-denominated bonds into gold, they are reducing dependence on debt expansion, currency volatility, and political risk embedded in the current system. Gold has no issuer, no maturity date, and no policy meeting behind it. It does not rely on promises. And that is precisely why it matters. The central banks have shown their cards. They are choosing gold as their ultimate insurance policy for the turbulence ahead. The question isn't whether gold is heading higher. It's how much of it you'll own before the supply truly dries up. This was just reason number 1. Stick around, because reason number 2, the Fed's pivot, is about to change everything you thought you knew about your savings. For the last few years, the Federal Reserve tried to fight inflation by making money expensive. They told us the higher for longer era was here to stay. But in 2026, the mask has slipped. The massive weight of government debt has forced their hand. They're not just cutting rates anymore. They are pivoting back to easy money. And every time the Fed blinks, gold investors win big. Here is why the 2026 pivot is the ultimate fuel for the gold rocket. Think about it. The U.S. interest payments on debt have now surpassed the entire defense budget. The system is suffocating under its own weight. To keep the economy from collapsing, the Fed has no choice but to push interest rates back down and restart the printing presses. When rates fall, the yield on savings accounts disappears. Suddenly, holding a paper dollar that loses value every day makes 0 cents compared to holding a 5,000-year-old asset that cannot be devalued. History shows that when real rates turn negative, gold goes vertical. We are entering that zone right now. The Fed has chosen inflation over a total market collapse. Now you have to choose. Do you trust the printer, or do you trust the gold? This was reason number 2. But wait until you see reason number 3. The debt monetization crisis. We've reached the endgame. In 2026, the United States is facing a mathematical nightmare that no politician wants to talk about. The national debt has hit a level where the interest alone is consuming the country's future. There's no longer enough tax revenue to cover the bills. This is the debt monetization crisis, the moment when the government starts printing money just to pay the interest on the money it already borrowed. And in this scenario, gold isn't just an investment, it's the only life jacket left. This is why the world's elite are moving into hard assets. They see the sovereign debt trap. If the Fed raises rates to fight inflation, the government goes bankrupt from interest costs. If they lower rates to save the government, inflation destroys the population. It's a lose-lose situation for the dollar, but a win-win for gold. As the debt-to-GDP ratio enters the danger zone, the global market is losing faith in paper promises. We are witnessing the birth of a new gold-backed era, born out of the necessity of survival. Gold is the only asset that hasn't failed in 5,000 years of human history. Reason number 3 is the engine of the 2026 gold rush. But wait until you see reason number 4, geopolitical fragmentation, and how the world is splitting in two. The world as we knew it is over. The era of global cooperation has been replaced by a new, colder reality. In 2026, We aren't just looking at trade wars. We are looking at a world splitting into two separate financial empires. On one side, the established West. On the other, the rapidly growing BRICS plus nations. And right in the middle, caught between these two giants, is the only currency they both still trust. Why is this happening? Because money has become a weapon. When you can flip a switch and turn off a country's access to its own savings, you change the nature of trust forever. Nations have realized that a digital dollar is a tether, a rope that can be pulled at any moment. To cut that rope, countries are building a financial iron curtain. They are demanding gold for their oil, gold for their minerals, and gold for their loyalty. In a world where you can't trust your neighbor's bank, you trust the metal in your own vault. This fragmentation is creating a massive supply squeeze. As the East hoards physical gold and the West tries to protect its currency, the available supply for everyday investors is disappearing. Gold is the only neutral asset left. It has no nationality. It doesn't need a central bank's permission to exist. It is the silent diplomat that works in New York, London, Beijing, and Dubai equally. We are moving from a world of promises to a world of assets. Geopolitics in 2026 isn't about borders anymore. It's about who holds the gold. This was reason number 4. But get ready, because reason number 5, the weaponization of the dollar, is where things get personal for your wallet. For decades, the dollar was the neutral ground of world trade. But when the world saw how easily the off switch could be flipped on a nation's reserves, the message was loud and clear. If your wealth is digital and dollar-based, it's not truly yours. It's a gift that can be taken away. This fear has sparked a global dedollarization race. Countries are no longer just looking for a profit. They are looking for an exit. They are selling their U.S. bonds and buying physical gold because nobody can freeze a gold bar in your own vault. The dollar might be the king of today, but gold is the emperor of history. As more countries look for a way out of the dollar system, the demand for gold is only going to accelerate. This was reason number 5. But wait, because reason number 6, supply peak and scarcity, is about to show you why there simply isn't enough gold to go around. We often think of gold as an infinite resource, just waiting to be pulled from the ground. But in 2026, we've hit a wall. Over 75% of all the gold on Earth has already been mined. What's left is buried so deep and in such hostile locations that the age of cheap, easy gold is dead and buried. Welcome to the greatest supply squeeze in human history. Think about this. If you took every single ounce of gold ever mined and melted it down, it would fit into a cube only 22 meters tall. That's barely the height of a 4-story building. That is the entire wealth of human civilization. Today, global demand is consistently outstripping mine production by over 1,000 tons a year. We're filling the gap with recycling, but you can only recycle the same gold so many times. The math is simple. The world wants more gold than the Earth is willing to give up. Mining isn't what it used to be. Today, companies have to dig miles underground, moving tons of solid rock for just a few grams of metal, all while facing skyrocketing energy costs. In 2026, the easy gold is gone. New major discoveries are at an all-time low. We are seeing a structural deficit that production numbers can no longer hide. When something becomes harder and more expensive to produce while the entire planet wants to buy it, the price has only one direction to go: higher. This was reason number 6. Stay tuned, because reason number 7, institutional portfolio shift, is about to show you where the real big money is moving. For decades, institutional investors, the pension funds and insurance giants, viewed gold as a relic of the past. They preferred the fast gains of tech stocks and the steady yield of bonds. But in 2026, the giant has finally awakened. We are witnessing a massive, structural shift in how the world's largest pools of capital are managed. The smart money is moving back to gold, and when trillions of dollars start shifting even a few percentage points, the price explosion is inevitable. Think about the scale. Most large funds currently hold near 0% or 1% in gold. But as inflation stays sticky and bonds continue to fail as a safety net, these funds are moving toward a 5% or even 10% allocation. This sounds small, but it represents hundreds of billions of dollars in new demand entering a very tight market. Companies like BlackRock and Fidelity are no longer just offering gold as an option. They are recommending it as a necessity. This institutional FOMO is creating a floor for the gold price that we've never seen before. The old 60-40 portfolio, 60% stocks and 40% bonds, died in the volatility of the mid-2020s. In 2026, professional money managers are desperate for uncorrelated assets, things that don't crash when the stock market does. Gold is the king of non-correlation. It's the only asset that doesn't rely on someone else's ability to pay a debt. As fund managers fight to protect their clients' wealth from a systemic collapse, they are all rushing through the same narrow door. And that door is made of solid gold. When the big money moves, the trend is your friend. We are only in the early stages of this institutional rotation. This was reason number 7. But hold on, because reason number 8, the second wave of inflation, is about to show you why your cash is losing value faster than you think. Everyone thought the dragon was slain. The headlines in late 2024 and 2025 promised a soft landing and a return to normal. But in 2026, the dragon has returned with a vengeance. We are officially witnessing the second wave of inflation. And history tells us that the second peak is almost always higher and more painful than the first. If you think your purchasing power is safe now, you're missing the most dangerous economic setup of our generation. Look at the 1970s. Inflation hit, it dropped, and the world relaxed. Then it exploded to double digits, sending gold prices up by over 800%. In 2026, we are following that exact blueprint. Energy prices are climbing again, supply chains are fracturing under geopolitical pressure, and the trillions in stimulus from previous years are finally reaching a boiling point. The Fed can't raise rates high enough to stop it without crashing the entire government. We are in a structural inflation cycle, and gold is the only asset that speaks the language of reality. Cash is no longer a store of value, it's a melting ice cube. In 2026, holding large amounts of currency is a guaranteed loss. The cost of living is rising, but the value of your gold is rising faster. The second wave of inflation is just getting started. This was reason number 8. But wait, because reason number 9, currency devaluation wars, will show you why nations are intentionally destroying their own money. In the world of global trade, there is a secret war happening right now that no one is calling a war. It's the race to the bottom. In 2026, nations are no longer competing to have the strongest currency. They are competing to have the weakest. It's called currency devaluation, and it's a desperate move to stay competitive. But there's a massive side effect. Your life savings are the collateral damage. Why would a country want a weak currency? It's simple. It makes their exports cheaper for the rest of the world. From the Eurozone to Japan, and even the US, central banks are quietly engaging in competitive devaluation. They are printing more, lowering standards, and letting their currencies slide to protect their industries. But when everyone tries to devalue at the same time, paper money loses its meaning. In this environment, gold becomes the only fixed point in a world of sinking currencies. It is the only money that no government can print away to gain a trade advantage. When nations go to war with their currencies, gold is the only neutral territory. The race to the bottom has no winner, except for those who hold the gold. This was reason number 9. But get ready for the grand finale. Reason number 10, the digital gold fatigue, and why investors are fleeing the screen to return to the vault. This is Gold Intelligence. Subscribe to see how the story ends. For years, we were told that Bitcoin was Gold 2.0. That code was the new collateral. But in 2026, the honeymoon phase is over. We are seeing a massive wave of digital gold fatigue. As regulatory crackdowns intensify and the reality of cyber vulnerability hits home, investors are realizing that in a true crisis, You can't eat, wear, or defend your future with a password. The big money is fleeing the screen and returning to the vault. Don't get me wrong, digital assets have their place. But they lack the one thing gold has provided for 5 millennia: zero counterparty risk. A digital coin requires a functioning internet, a power grid, and a platform that hasn't been seized by the government. Physical gold requires nothing but its own existence. In an age of AI-driven deepfakes and CBDCs, central bank digital currencies, physical gold is the ultimate analog escape. It's the only asset that is truly off the grid, and in 2026, privacy is becoming the most expensive luxury in the world. We are witnessing a historic rebalancing. Crypto millionaires are diversifying into the real thing to lock in their gains. They've realized that while Bitcoin can go up 10% in an hour, it can also vanish in a heartbeat if the exchange goes dark. Gold doesn't go dark. It doesn't crash to zero. It doesn't need an update. This shift from speculative digital to proven physical is driving a massive, sustained demand that the market wasn't prepared for. The smart money is choosing atoms over bits. 10 factors. 1 conclusion. Gold is no longer just an option, it's an essential. The 2026 rally is more than a price move. It's a global reset of value. You've seen the intelligence. Now the move is yours. Will you wait for the next peak? Or will you secure your position today? This is Gold Intelligence. Subscribe to stay ahead of history. We'll see you in the next video. Good luck, friends.